Hello, and welcome to The Advantage Investor, a Raymond James Limited podcast, a podcast that provides perspective for Canadian investors who want to remain knowledgeable, informed, and focused on long-term success. We are recording this on March 6, 2024. I'm Chris Cooksey from the Raymond James Corporate Communications and Marketing Department. And today, mutual fund and ETF specialist Luke Kahnert returns to the podcast. Today, Luke and I will be discussing the goings-on in the Canadian mutual fund and ETF space. Welcome back to The Advantage Investor, Luke. Thanks for taking the time. We are headed towards episode 100. You are episode 91, I believe. You're getting close. We're getting close to that big number. So thank you for taking the time to join today, and look forward to hearing what you have to say. I hope you're doing well.
That's great. Thanks for the opportunity, Chris. I thought you were about to say I'm episode 100. I was getting pretty excited.
Hey, play your cards right, and you can be. Anyway, glad you're doing well. Obviously, this is a very large part of the Canadian investment landscape, so a lot to talk about, and let's jump right in. And let's start off with a nice broad-based question. What is new in the Canadian mutual fund and ETF industry?
Sure. So I came prepared with some data from IFIC's annual funds report for 2023. So for our listeners, just to clarify, IFIC is the Investment Funds Institute of Canada, and they regularly release these monthly reports on mutual fund and ETF data within Canada. But they also release an annual report that comes out with some great data, just summing up the calendar year, but also illustrates some ongoing trends that we've seen in both mutual funds and ETFs over the last decade or so.
So what, I guess there's probably some important takeaways from these reports, important stuff in the executive summary, so to speak. So maybe you can just comment on that.
Sure. So the biggest thing, biggest takeaway from the report from last year or 2023's annual report is the ETF industry continues to grow consistently year over year. When looking at ETF growth for 2023, ETF assets grew by almost 22%, whereas mutual funds grew by about 7%. It's also, though, important to note that, when we evaluate and look at it from a total assets perspective, mutual funds still dominate, with 1.9 trillion in net assets as of the end of 2023. And, at the end of the year, ETFs were occupying about 382 billion. So there's still a lot of room for ETFs to catch up in terms of total assets, but certainly some strong growth coming from the ETF industry.
Now, when we think of those growth trends, do you think it's a case of ETFs catching up to mutual funds, or some mutual fund investors, going to ETFs and thereby balancing it out eventually, or maybe a little column A, a little column B?
Yeah, that's an interesting question. I think, so first off, I think both mutual funds and ETFs are great investment vehicles to consider, and there may be an advantage in using one versus the other for a specific investment scenario that a Raymond James advisor can certainly help explain. When you look at the data over the past decade, ETFs have certainly outpaced mutual funds in terms of growth. So the trajectory over long term points to ETFs continuing to maybe close that gap in assets over time, depending on how fast that is, who knows. But there's a lot of reasons for why there's been such strong growth within ETFs, that's for sure.
What are some of the reasons why maybe new investors are going towards ETFs? Maybe what's fueling this growth, if you will?
So good question. The number of players in the ETF industry that are now focused on strategies outside of traditional passive index ETFs have helped in terms of growth. And so these strategies will include what are called rules-based or smart beta ETFs. In addition, there's an increasing number of active ETF strategies that are available in the marketplace. Typically, ETFs have been known for their passive characteristics, and now that we're finding so many new flavors within smart beta, rules-based, and active ETFs, there's just so many more solutions that investors can find that go beyond just that pure passive index ETF exposure. The second thing I'll mention too is we're seeing more and more asset managers launch ETF versions of existing funds. So by funds, I mean existing mutual funds. So from an investor's perspective, this provides just another option to access an active strategy that was previously only available in a mutual fund structure. So if an investor's preference is to use an ETF, they may now be able to access that mutual fund strategy they've grown to love over the years in ETF form. So I'm seeing many mutual fund providers now look at growing out their ETF shelf using existing mutual fund strategies. And again, there are times where a mutual fund structure may be advantageous to an ETF structure and vice versa. But in any case, the increasing number of ETF purchase options is definitely a tailwind for the ETF, overall ETF industry growth. Thirdly, institutional clients are now big users of ETFs, so that definitely helps ETF flows, especially over the last decade. And the last thing I'll mention, Chris, is that the ETF industry just continues to innovate. It seems like, every year we're constantly seeing new products come to the market to help address a specific investor need. And this push for innovation has certainly contributed to supporting the ongoing growth that we've seen within the ETF marketplace over the last decade.
And just as a point of clarity, when you said passive ETFs, those are the first ones that came aboard. Your spiders, your QQQs, your tips. They just mimicked the index. So whatever the index returned, the investor returned, basically.
Exactly. Yeah, okay. That's correct. The world's first ETF was launched in Canada in 1990. The ticker is XIU, and it's the iShares S&P TSX 60 Index ETF. So pure passive exposure.
Okay. And then, as you said, now it's starting to evolve, and whatever you're playing, whatever oil, more specific sectors or whatnot. And that's what's fueling the growth, is the options within the ETF space has grown tremendously.
Exactly. Yes.
All right. What are some of these? We got that out of the way. Now you mentioned briefly the rules-based ETFs. Maybe just come up with what that means, because it's a lot more complicated than mimicking an index, I would imagine.
Absolutely. Yeah. So I just mentioned that one ticker being the first ETF ever launched in the world, XIU, purely passive, tracking an index. So that's where kind of ETFs first became popular, for lack of better words. But and since then, ETFs have kind of been labeled as passive strategies, because that's where it began, as index tracking vehicles. And then, on the flip side, mutual funds have always been looked at as their active counterparts. So, an active strategy will include a portfolio manager that is evaluating investment opportunities, buying, selling, trimming positions within the portfolio. And the ultimate goal is to outperform their respective benchmark, which is usually an index such as the TSX in Canada or the S&P 500 in the US.
So a combination of indexes.
Yeah,
correct?
Yeah. So there could be a blend. So it all depends. And this is something that's predetermined within the investment approach of the mutual fund, or ETF now, for that matter. But anyways, yeah. So it's kind of a long-winded answer, but this way of thinking has obviously changed, with ETFs just being passive, mutual funds being active. As now there's rules-based ETFs. They'll follow a predetermined set of rules in their investment methodology. And some examples include low volatility ETFs, momentum ETFs, dividend ETFs. So ETFs are tracking companies that pay out a dividend. And so this really kind of opens up the number of options that we have now, just growing from that pure passive index ETF, where it all kind of began. And then, just kind of, again, building off of that rules-based ETF methodology, what you'll find is it's kind of a midway between active and passive. And typically what you find is the MER will also land somewhere in between that passive and active MER. I mean, over the years, the media oftentimes compares ETFs to mutual funds, but now that the line's blurred so much between the two vehicles, we've got all these different kinds of ETFs available. The real comparison that I think is worth following is active versus passive.
Right.
Which is a whole other discussion. But
right. Yeah. No, absolutely. And is it a consolidation of the industry that's bringing everything together, or is it just a little bit of both? It's just the way it is. What opportunities are out there for managers and that sort of thing?
Yeah, exactly. I mean, there's been a lot of growth and innovation. We're seeing a lot of products that include derivatives within their investment methodology. In the past, I think now that fixed income has become a popular asset class today, with where rates are, there's more of a focus now on fixed income ETFs and mutual funds, for that matter. So it really depends on the environment, I would say, but ETFs have kind of helped out in a lot of different ways. I guess just kind of sharing a few others, like one that comes to mind is physical gold ETFs. So great innovation where the ETF provides that convenient structure to provide exposure to the price movements of gold without the investor having to actually hold the physical commodity, which is obviously very convenient.
Also would strip out the company aspect of it. If the company is making the right decisions, you're just investing in the commodity itself rather than the industry per se.
Exactly. Yes. Or there's also ETFs that will, provide exposure to gold producers as well. So you can do that as well. So there's so many ways where you can find very sort of specific exposures, and an ETF vehicle and a mutual fund vehicle are both very convenient for I guess adding that to a specific sleeve in a portfolio. But yeah, I mean, even over recently, sorry, I was just going to say, even over recently, we're seeing growth in asset allocation ETFs over the last 5 years or so. And this is like an ETF of ETF structure, if that makes sense.
Okay.
Yeah.
So like the old fund of funds almost then, right? Like it's your whole portfolio based on a few ETFs type situation.
Exactly. Yeah. So you can get, with one ETF, you gain exposure to say 5 ETFs, underlying ETFs that are within the portfolio. So right. Fantastic way to just simply diversify with one ticker.
Now, I imagine you look at more than one piece of research, and it's not just the IFIC report. So what other research caught your eye last year coming into this year?
Great question. Last year was dominated, in terms of flows, were dominated with money market ETFs in particular, and funds too. A lot of interest, investor interest was falling into HISA ETFs, T-bill ETFs, or just traditional money market ETFs, which is interesting. Like just looking, and I get reports, from our ETF partners. When you look at year to date, and of course, it's only been 2 months, but when you look at year to date flows, it's almost completely flipped. Where now there's been so much interest and investor demand in U.S. equity and international equity ETFs. We're actually seeing some outflows out of those money market ETFs that were gaining so much traction. And that's just a byproduct, I think, of what we're seeing this year and maybe what the market is pricing in terms of rate cuts.
Right. So that's what I was going to suggest, that like obviously the interest rate environment plays has a huge impact into that, because if rates go up and you can get whatever 5%, I don't even know if that's realistic, so you can correct me there. But like if we're getting 5% in a ETF or a GIC or whatever, then that doesn't mean I necessarily have to put as much into the equity markets. And as investors and professionals start thinking rates are going down, all right, how do we position the portfolio to take advantage of any growth that might come because of the rate/inflation environment?
I think you nailed it. I think it's a great way to measure investor sentiment by looking at flows. And also when you see launches of specific ETFs as well. So year to date, just this year alone, I'm seeing a lot of continued interest in launching fixed income ETFs. And in particular, there are many target date bond ETFs that have come to market, where I know we're kind of touching on a lot of different, variety of ETFs here, but these ETFs act like a standalone bond. They mature like a bond. They offer income like a bond, but they also incorporate some of the benefits of an ETF structure, such as diversification, liquidity. They're exchange listed. So there's a focus right now, and I think that's a byproduct of where the current sort of interest is, and ETF providers are kind of showing that they're addressing that need.
Now, I'll give you a chance here to predict the future, because that's always fun in this business. What would you expect to see in next year's report, as we are a whole 2 months in, and you get to guess at 10 future months of action here?
Yeah. Okay. So that's a good question. No one's got a crystal ball, of course, but I think the biggest factor in next year's report is going to be driven by interest rates in some capacity. And what I mean by that is the first way interest rates, I think, will affect next year's report, if you will, is we may see the number of ETFs launch decrease due to this, higher for longer interest rate environment that is expected. So when a new ETF comes to market, one of the key elements is seed capital. And that seed capital is the initial funding that allows an ETF to launch and become available to investors. So when interest rates were low and money was basically free, seed capital was easy to get. And as a result, we saw many ETFs launch. Now, with higher interest rates, the higher funding costs may lead to some challenges for ETF issuers when launching new products. And just as a result of this, I'd expect ETF issuers to be really specific, maybe about the types of products they're launching in this new rate environment. The second way interest rates, I think, will affect next year's report is, I think, I touched on this a little bit earlier, but I believe we will see, a focus on fixed income strategies. And this is for both mutual funds and ETFs. And the reason being is it's been a very long time since rates have been at this level. And so, there's obviously been, like we had discussed, a lot of innovation within the investment industry. And with that in mind, I think that, bond markets are attractive again. There's a lot of catch up to be made within ETF innovation, mutual fund innovation within this asset class. So that's the second reason. And then the third way that interest rates will affect, I believe, will have an impact on next year's report is when we look back over the past decade, specifically when you look at the data in the IFIC report. I know I had mentioned that we're seeing year over year ETF growth. The consistent theme until recently is how low rates have been. Moving forward, so like moving forward, that era of low interest rates is past, and one of the things I'm watching is whether active managers will now be in a better position to outperform their counterpart passive strategies.
Right.
That makes sense.
Now, just one last question here. Should be an easy one for you to answer. If you were talking to a investing novice, so someone who's just starting to invest, or like I would say my mom, someone like that, and they said, Luke, I put my money in and I buy part of this mutual fund. And then, Luke, I put my money in, I buy part of this ETF. What is the main difference? Because my answer would always be, well, you're buying an actual security when you buy an ETF that trades on the market. Whereas when you're buying a mutual fund, yes, it's a group of stocks, but you're buying sort of an investment group or an investment strategy based on what you're looking to achieve. And you don't really own the securities. You buy part of the group that owns the securities. I probably complicated that unnecessarily, but is that basically the difference between the two?
Yeah, it's a great question. I think just to put simply, the lines have blurred so much that there may not be a huge difference between the two. Like I mentioned, There are many mutual funds that are now available in an ETF form.
Right.
And when you look at the two, it really is just a matter of how you want to access the strategy. By buying the ETF, you're buying it over the exchange. So there might be some price fluctuations there to consider. And that's where you get into kind of like how efficient the ETF is trading. And an advisor can certainly help. A Raymond James advisor can help explain all of that. Whereas a mutual fund trades end of the day NAV. That's the biggest difference between the two. And so there are pros and cons with going with one route versus the other. But I think,
and you should talk to your advisor about those differences, Luke.
Exactly. I think so.
Yeah. Awesome. Well, I want to thank you for taking the time today. Really appreciate it. Always a pleasure to speak with you. And I look forward to your next visit.
Great. Thanks so much for having me, Chris.
Reach out to us at advantagedinvestorpod@raymondjames.ca. Subscribe to The Advantage Investor on Apple, Spotify, or wherever you get your podcasts. Please contact your advisor with any questions you have. On behalf of Raymond James and The Advantaged Investor, thank you for taking the time to listen today. Until next time, stay well. This podcast is for informational purposes only. Statistics and factual data and other information are from sources Raymond James Limited believes to be reliable, but their accuracy cannot be guaranteed. Information is furnished on the basis and understanding that Raymond James Limited is to be under no liability whatsoever in respect thereof. It is provided as a general source of information and should not be construed as an offer or solicitation for the sale or purchase of any product and should not be considered tax advice. Raymond James advisors are not tax advisors, and we recommend that clients seek independent advice from a professional advisor on tax-related matters. Securities-related products and services are offered through Raymond James Limited, member of the Canadian Investor Protection Fund. Insurance products and services are offered through Raymond James Financial Planning Limited, which is not a member of Canadian Investor Protection Fund.